Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago, for a bit more on these moves. Larry, is that what you put this down to with the move in the oil price, the shale glut worries? Is that really continuing to have quite a big impact, I guess, on oil traders?
Yeah, I think it will. Let's keep in mind the last few months as oil rallied, it did so because three legs of the stool, everything has happened perfectly, keeping the oil price up. Now it's starting to be questioned. I mean, obviously the latest drop in the price was due to this risk-off selling. But from here on out, I think even though the fundamentals might not change that much, they're actually okay. There's other things we should worry about, and that is U.S. shale supply. Is that going to finally invoke a response from OPEC? That's something I'm betting on anyway. Also, diesel demand. I still think it's just going to decelerate from a very high level from 700,000 to 500,000 barrels a day. That's still really good, but not good enough to keep prices up. It's going to weaken structure, et cetera. And then also, if you notice, last week's DOE report came out slightly bearish, maybe even more than slightly bearish, but the market got slammed. So finally, we're looking at reports and looking at near-term fundamentals. And I think there's going to be a lot of burden of proof on the bulls for oil price to ratchet back up to where it was even a month ago.
We know the currency moves obviously having quite a big impact on commodities at the moment, Larry, and we were seeing the greenback last week kind of gaining because investors were seeking havens with all of that market turmoil, but it seems to have lost some traction this week as markets are looking to be stabilising. I note that the dollar index, I think, had fallen about 0.4% again today. Are you expecting further weakness in the greenback, and therefore that will provide further support for commodities like oil?
Yeah, I do think the dollar will continue to drift lower, but I think the market will finally get to the point of realizing this is all about global macro stability. It's not about financial instability. Definitely will be a slight tailwind to commodity prices, and especially as we've seen, but I don't think we're going to see the drop in the U.S. dollar that some people are predicting.
All right, let's move on to the market there. What are you making of some of the moves? Obviously, well, look, we were talking about volatility earlier with Alan Nuckman and extreme volatility that we've been seeing recently, or certainly last week. For a lot of the session today, we were watching a downed day, but you do get a sense that markets are sort of calming down right now and sort of stabilising. What is your sense on things? Have we sort of hit that bottom? Are we out of the woods, or do you think there is sort of more of this volatility to come?
Yeah, I don't think we're out of the woods by any stretch, but it's really good to see a healthy consolidation. And after 3 weeks, I'm finally able to say we're consolidating. That said, there's a lot of catalysts that really matter, especially tomorrow's CPI. We have Fed speaking at the end of the week, the end of the month, and next month we have decisions from the FOMC and ECB. All of these are going to be addressing that catalyst that people are starting to look at, and that is public debt. And bonds, in my mind, have moved for the right reasons so far this year, but let's face it, we're adding $1 trillion to the U.S. debt every year for the next 3 years. If people start to question that, or that starts to become a front and center issue, that could be a real problem. We still have a large cushion between where bonds are now and the 20-year average, about almost 100 basis points still. So I don't think it's a huge headwind for equities right now, but it potentially could be. So I think people are just starting to rethink all of this and not be so casual about public debt, which is, absolutely enormous, being our tax receipts are less than $2 trillion, and our U.S. deficit is a little bit over $20 trillion.
Well, just on that bond market route, I know that a lot of hedge funds and market speculators are betting that the bond route will continue. And there was an analyst from Goldman Sachs actually that came out warning that those 10-year Treasury yields could rise to as high as 3.5% in the next 6 months or so, obviously as the market prices in a steeper pace of Fed tightening. That seems pretty high. I mean, I know that the 3% mark is where everyone was sort of saying, look, that's where we start to get concerned. 3.5% though, that would be pretty high. What are you predicting? How high do you think we could see those yields going?
Yeah, well, I don't see anything higher than like 3.25 by the end of the year. I've become a little bit a little bit more bearish, just because looking at the trends in U.S. labor reports suggesting that there's still going to be downward pressure on the unemployment rate and upward pressure on wages. So maybe we'll see a yield of 3.25. But if it even raises to 3.5 in the next 6 months, as long as it's doing so for the right reasons, meaning that there's a nominal amount of inflation here and there's growth in Europe, then I'm not overly concerned. But let's do keep in mind that right now I think there'll be more consolidation. I think Europe has some time to catch up on the yields compared to the U.S.
You mentioned that inflation print. Sorry, just to finish on this, and I mean that's going to be crucial, isn't it? Because obviously that wages growth print that came through a couple of weeks back, that's really what sparked things off. Whether or not it was overblown, I guess that's another question. But the inflation print tomorrow, I mean, if that does come through better than expected, and we do again start to see those signs of inflationary pressures, do you think that again could spark another big sell-off in the equity market?
Yeah. I think it definitely could help, because the hardest thing right now, we know if the number comes out too hot, that's definitely a headwind and we'll see yields back up a little bit. If the number comes out in line or under expectations, that's when everybody scratches their head and say, well, is that risk on? Is that bad? So that's why I think it's so slow behind me and volumes are so dried up, because I don't think people know what to do with the number. And you have that, and then people will be waiting until the end of the month for more Fed speak. So yeah, I mean, obviously if the number comes out hot, it would be a headwind to the market. But other than that, it's anybody's guess.
Mm-hmm. And just finally to finish up, I mean, you mentioned those European markets, and when we talk about finding opportunities in a market like this, are you getting the sense that investors are rotating out of equities and more so into cash? What are you kind of doing, and have you readjusted your portfolio or asset allocation going forward?
Yeah, no, I have not readjusted my allocations. I continue to be overweight Japan, overweight Europe. Tend to really be heavily weighted in the financial sector, also some cyclicals there. I think that's the place to be. And from the U.S., I'm talking about unhedged positions. I do think the dollar has a little room to go down, especially against both of them, and the yen being more of a safe haven than the euro would be. So no real other allocations. I continue to hold a short in oil and still think it's got some room to go down. When it comes to the U.S. dollar, I'm generally flat.
Okay, fantastic. Look, Larry Schofield, we'll leave it there. Appreciate you joining us as always, though. Thank you so much.
Thank you.